The stock market can sound intimidating. People throw around words like yields, payout ratio, or ex-dividend date, and suddenly it feels like you need a finance degree just to keep up. Confused? You're not alone. In this video, I'm breaking down dividend stocks in plain English. No jargon, no complicated charts, just the simple truth about what they are, how they work, and whether they might be right for you. By the end, you'll understand why so many investors rely on dividends as a steady stream of income and how you can start thinking about them too. So let's start with the basics. What exactly is a dividend stock? A dividend stock is simply a share of a company that pays you money just for owning it. That payment is called a dividend. It's usually a portion of the company's profits sent back to shareholders as a reward for investing in the business. Think of it like this. If you own a rental property, your tenants pay you rent every month. With dividend stocks, the company is your tenant, and the dividend is the rent. Except here, you don't have to deal with fixing leaky sinks or chasing people for late payments. Most companies that pay dividends are well-established, profitable businesses. Think Coca-Cola, Johnson & Johnson, or Procter & Gamble. These companies aren't just chasing the next big thing. They've already built empires, and they share part of the profits with their investors. So instead of only hoping the stock price goes up, dividend investors get paid along the way. It's like owning a tree that grows in value, but also drops fruit into your basket every few months. Okay, so now that you know what dividend stocks are, let's talk about how dividends actually work. When a company makes a profit, they have a choice. They can reinvest that money back into the business, maybe by building new factories, hiring more people, or developing new products. Or, if they're already stable and profitable, they can share part of that money with shareholders through dividends. Dividends are usually paid out in cash, deposited straight into your brokerage account. It feels almost like a paycheck from your investments. Some companies also offer stock dividends, where instead of cash, you get extra shares of the company. But for beginners, most of the time we're talking about cash dividends. Now, how often do you get paid? Most companies pay dividends quarterly. That's 4 times a year. Some pay monthly, which can feel like a second salary. Others pay semi-annually or even once a year. It all depends on the company's policy. Let's take a real example. Coca-Cola is famous for paying dividends. If you own 10 shares and Coca-Cola pays $0.46 per share every quarter, that means you get $4.60 every 3 months just for holding those shares. Doesn't sound like much, right? But here's the magic. If you own hundreds or thousands of shares, those small payments can add up to serious money. And if you reinvest those dividends instead of spending them, your investment grows faster thanks to compounding, which we'll get into later. There are also a few important terms to know. Ex-dividend date. This is the cutoff date. You need to own the stock before this date to receive the next dividend. Buy it after, and you'll have to wait until the next cycle. Record date. The official day the company looks at its shareholder list to see who qualifies for the dividend. And finally, payment date. The day the money actually hits your account. It sounds like a lot, but here's the simple way to think about it. If you own a dividend stock before the ex-dividend date, you'll get paid when the company distributes profits. Easy as that. So why do investors love dividend stocks so much? Here's the thing. When you buy a regular stock, you're hoping the price goes up so you can sell it later for a profit. But that means you only make money if the stock price rises, and you might have to wait years. With dividend stocks, you get a second way to earn. Not only can the stock price grow over time, but you also receive regular cash payments along the way. It's like getting paid to wait. Let's break down the main reasons dividend stocks matter. 1. Steady income. Dividends provide consistent cash flow whether the market is up or down. For retirees, this can act like a paycheck. Even if the stock price takes a dip, those quarterly payments can help cover living expenses. 2. Stability. Most dividend-paying companies are well-established, profitable businesses. Think utility companies, big consumer brands, or financial institutions. These aren't high-risk startups trying to make it big. They're solid players that have been around for decades. And 3, reinvestment power. If you don't need the cash right now, you can reinvest your dividends to buy more shares. More shares means more dividends, and that cycle creates compounding growth. Over decades, this snowball effect can turn small investments into large portfolios. 4, hedge against volatility. Dividend stocks often hold up better during market downturns. Why? Because investors know they'll still get paid dividends, even if stock prices fall. That makes dividend stocks less likely to be abandoned in a panic compared to growth stocks with no payouts. 5, retirement planning. For many people, dividend stocks are the foundation of a retirement portfolio. Imagine building a portfolio that pays you $1,000 a month in dividends. That's like having an extra income stream without needing to clock in for work. Here's a simple picture. Growth stocks are like planting seeds and waiting for them to grow into big trees one day. Dividend stocks are like owning fruit trees. The tree still grows, but it also drops fruit you can enjoy along the way. That combination, growth plus income, is what makes dividend stocks so powerful. All right, now you might be thinking, cool, dividends sound great, but how do I actually judge whether a dividend stock is good or not? That's where a few key numbers come in: dividend yield and payout ratio.
Dividend yield. This is probably the first number you'll see when looking at a dividend stock. It tells you how much income you'll earn compared to the price of the stock. The formula is simple. Annual dividends divided by stock price equals dividend yield. Example, if a stock costs $100 and it pays $4 a year in dividends, the yield is 4%. That means for every $100 you invest, you earn $4 each year in dividend income. Sounds easy, right? But here's the catch. A higher yield isn't always better. If you see a stock with a 12% or 15% yield, it might look tempting, but often that's a red flag. It could mean the company's stock price is dropped because the business is struggling. If the company can't sustain those payouts, they might cut the dividend altogether. So yield is important, but it's not the only thing. Payout ratio. This tells you how much of the company's profits are being paid out as dividends. For example, if a company earns $1 billion in profit and pays out $500 million in dividends, the payout ratio is 50%. A healthy payout ratio usually falls between 30% and 60%. That means the company is rewarding shareholders but still keeping enough money to grow the business. If the payout ratio is too high, like 90% or more, it could mean the company is paying out almost everything it makes. That's risky, because if profits fall even a little, they may not be able to keep paying dividends. Other things to look at. Dividend growth. Has the company been raising its dividend consistently? A business that increases dividends every year shows strength and commitment to shareholders. Track record. Companies known as dividend aristocrats have paid and raised dividends for at least 25 years straight. These are the gold standard for reliability. So to recap, yield tells you what you get today. Payout ratio tells you whether you'll keep getting it tomorrow. Now that you know how to evaluate dividends, let's look at the different types of dividend stocks you'll come across. Not all dividend stocks are the same, and each type serves a different purpose in your portfolio. Here are the main categories. Blue chip dividend stocks. These are the big, stable companies that have been around for decades. Think Coca-Cola, Johnson & Johnson, or Procter & Gamble. They're known for paying reliable dividends year after year. They're not the fastest growers, but they're like the safe anchors of a portfolio. High-yield dividend stocks. These stocks pay a larger dividend compared to their price. You'll often see yields of 6%, 8%, even 10% or more. Sounds great, but remember, high yield usually means higher risk. Sometimes the stock price is down because the company is struggling, which pushes the yield up. High yield can be good for income seekers, but you need to make sure the payout is sustainable. Dividend growth stocks. Instead of offering huge yields, these companies start with modest dividends but increase them consistently over time. For example, a company might start by paying 2% today, but if they raise that dividend by 10% every year, in 10 years, you could be earning much more on your original investment. These are great for long-term compounding. REITs, or real estate investment trusts. REITs are companies that own or finance real estate, like apartments, shopping centers, or office buildings. By law, REITs have to pay out at least 90% of their profits to shareholders as dividends. That means they usually come with high yields, often in the 4 to 8% range. The trade-off is that their growth might be slower, but they're popular with income-focused investors. Utilities and telecom stocks. Think power companies, water providers, or phone or internet companies. People need these services no matter what's happening in the economy, which makes their dividends very steady. They don't usually grow fast, but they're dependable. Dividend aristocrats and kings. We touched on these earlier. Aristocrats are companies that have raised their dividends for 25 years straight. Kings have done it for 50 years plus. These are the cream of the crop for consistency and reliability. So to recap, blue chips equals safety and stability. High yield equals bigger income but higher risk. Dividend growth equals small now, big later. REITs equal real estate income without buying property. Utilities and telecom equals steady and defensive. Aristocrats and kings equals proven winners. By mixing different types, you can build a dividend portfolio that balances income, growth, and safety. So here's the big takeaway. Dividend stocks aren't just about making your money grow. They're about getting paid while you wait. Whether you want steady income, long-term growth, or a solid foundation for retirement, dividend investing can be a powerful tool. Just remember, don't chase the highest yields. Focus on quality companies and think long-term. Dividends work best when you let compounding do its magic over years, not weeks. If you found this helpful, hit that like button, subscribe for more beginner-friendly investing guides.